is virtually impossible to have a course on technical analysis without discussing pattern recognition. And in this chapter, we'll be looking into such esoteric names as head and shoulder patterns, double bottoms, double tops, wedges, and the like. Let's take a look at the axiom of an uptrend. Although Dow theory was concerned with the overall interaction between different indices and attempted to gauge the health of the business environment, his work on technical analysis is still applied to any chart in any time frame. A bull trend made up of a series of higher highs and higher lows. On the chart, this is referred to as rising tops and rising bottoms. It doesn't matter if this is on a 1-minute chart or a 5-minute chart or on a daily chart or whatever time frame you're looking at. But it raises an interesting point which I want to make sure you understand and appreciate immediately. My own trading strategies are based on the principle of fading the short-term trend in the direction of the long-term trend. It means that if I see the trend on a 15-minute chart is up, I will buy the dips on the 5-minute chart, even though it looks as if the market is moving lower on the 5-minute chart. I am essentially fading the move on the 5-minute chart in the direction of the move on the 15-minute chart. Fading means I'm going against the trend. I'm doing this because I want to trade in the direction of the trend that I am following. We'll talk about this concept in far greater detail in chapter 12, but for now, I want to take you through some of the most popular trading patterns. It's called pattern recognition. What you should know about these trading patterns is that they can occur on any time frame. But it is important that you realize that the longer the time frame you are looking at, the more significant the result is going to be. But it may also take longer to unfold. The trading channel is one of the easiest patterns to trade. It is simply a question of connecting a high with the next high and project it in a straight line into the future. It gives you a projection of where the next move in the market will run out of steam. I've included a couple of charts for you. The second chart demonstrates this concept on the Euro-Yen chart on a 30-minute time frame. As the trend moves lower, the parallel line does a great job in forecasting the potential support for the currency pair. At this point, as a trader, you may either consider initiating a long position, or if you had been short the market, you may want to move your stop down tight to protect your profits on your position. The uptrend on this chart follows the parameters for one of the fundamental laws of technical analysis perfectly. The market is progressing higher in a series of higher highs and higher lows. But what I need you to focus on, though, is where the market stops on the retracements. A retracement is a move against the prevailing trend. One of the primary laws of technical analysis is that of support and resistance. It states that once an area of resistance has been broken, it should now act as an area of support, i.e. a place where traders will be looking to buying. In this case, you can view a previous top as an area of resistance. Once that top has been penetrated by the price action and the trend is carrying the price higher, you can draw a horizontal line through the old high to indicate that this area may now be a place where traders will be looking to buy. The law states that once old support has been broken, it may now become new resistance. And once resistance has been broken, it may now become new support. Now, you may think that I'm a bit woolly in my expression here, but I use the word may simply because there are no certainties in the market. Anything can happen. So it would be wrong for me to say that it categorically will become support or resistance. This stair-step pattern is the hallmark of a trend, and as you will see next, the same principle applies to the downtrend. The downtrend is simply the opposite of the uptrend. Here we are seeing a series of lower highs and lower lows. On this chart, I have shown a trend line break, which is often a good indication that one type of trend is over and a new trend is starting. You should notice how the lows on the way down now define areas of resistance on the retracement moves higher. This is the hallmark of support and resistance and trend analysis. If you are looking to get short the market, the place to consider placing the position is in the area of resistance as defined by the horizontal line from the old low. The double top is one of my favorite patterns. It's easy to spot in that you are looking for a market which is trading at or near an old top. In the chapter on candle charts, I talked about different styles of trading. As a trader, you can be aggressive, or you can be neutral, or you can be more cautious. I would not like to say what I recommend. I think you should find your own trading style. For me, I am sometimes very aggressive in my trading style, and sometimes I'm neutral or even slightly cautious. It varies with the circumstances of how I feel about the trade that I want to place or the market in general. For example, if I know that a major holiday in the US is approaching, I tend to be more cautious on my trading approach because I know many traders will have left the trading desks early, and that can severely affect liquidity in the market. When it comes to double tops, I like to be aggressive though. If the market warrants it, I prefer to sell short the market at or even just above the old high, speculating that the market will reverse back down again. I need to have some compelling reasons for doing so. It could be that the larger time frame I'm looking at is still trending down. A more cautious approach would be to wait for the market to print a bearish candle after having made the double top, such as a bearish engulfing pattern or a doji, and then go short. An even more cautious approach would be to wait for a trend line break like you're seeing on the chart in front of you now. It depends on your trading style. The more aggressive you are, the more you will make when you are right, because you're getting in at a better price than if you wait. However, the drawback is that you're not waiting for confirmation and you may have jumped the gun by going in too early. It's a fine balance between risk and reward, and only you can answer what is best for you. The double bottom is traded in an identical manner to the double top. I have printed the volume figures underneath the chart to indicate that volume is surging on the lows. So whenever I trade stock index futures, I will inevitably look at volume as well, because I know from experience that volume will surge when important highs or lows are made. Looking at it on a graph with the benefit of hindsight is one thing, but actually trading it in real time is a different matter altogether. However, if I can get you to recognize the patterns in the calm and the comfort outside the trading ring, there's a much better chance you will recognize them when you are in the thick of the trading day. The most widely recognized pattern in the financial markets. I've heard die-hard journalists on Bloomberg and CNBC talk about this pattern. And it is true that the forecasting power of the head and shoulder pattern is quite powerful. It is easy to spot, but it may not be so easy to trade. It depends on how aggressively you want to trade it. Let's have a look at the setup. The market is making a series of higher highs and higher lows, so we know the trend is up. The first real alert you receive that a head and shoulder pattern is forming comes when the trend line, which has connected all the lows, has been broken. The patterns often form a horizontal or near horizontal support line. On the head and shoulder pattern, this is called the neckline, and it is an important ingredient in the pattern because if the neckline breaks, the head and shoulder pattern has been confirmed. The right shoulder is the place where I, as an aggressive trader, will be looking to place a short position for a bearish head and shoulder pattern. I will be looking for the market to make a candle pattern indicating that the market is heading lower. It could be an engulfing pattern or it could be a doji. Most patterns come with a target price. For the head and shoulder pattern, the target is calculated as the distance the market has traveled from the top of the head to the baseline or the neckline. The target is found by adding this distance to the base of the neckline, projecting a target to the downside. The much less aggressive approach to trading the head and shoulder pattern is to place a short sell order near or at the baseline or neckline and hope that the market will come back and fill your order once it has broken through the neckline. Sometimes the market simply runs away